Hello, everyone, and welcome to NCST's biweekly community impact briefing. My name is Erin Persons. On behalf of my colleagues at the National Community Stabilization Trust, we're happy to be back with you this week. Before we turn things over to our guest speaker this morning, I wanted to provide an update on the Middle Neighborhoods Initiative. I hope many of you were able to join us on our last call or listen to the recording and have visited the Middle Neighborhoods website at middleneighborhoods.org to learn more and join the community of practice. The next two Middle Neighborhoods calls will focus on Black middle neighborhoods in legacy cities. The first, focusing on challenges and opportunities in Black middle neighborhoods, will take place on Tuesday, August 4th, while the second will focus on strategies for their stabilization and revival and take place on Tuesday, August 25th. Look out for email invitations later this week with more information. In addition to this work, there are exciting developments on both the Neighborhood Homes Investment Act and Main Street lending that will be covered in our policy update, so please stay with us after our guest speaker to hear more. Please be sure to continue to visit NCST's resource page for updates on all of our activities. And don't forget to mark your calendars for our next call, which will be on August 5th, where we'll be joined by Ann Myers and Robert Hickey from Habitat for Humanity International. At this time, I'm going to turn things over to our president, Julia Gordon, to introduce our guest speaker for today.
Hi, everyone. As always, this is one of our favorite times of the week when we get to have this call and be with everybody together, as most of us continue to be quite distanced. We are really excited this week to have Tony Pickett with us, whose organization, Grounded Solutions, we definitely consider one of our very close allies in the work that we do. Grounded Solutions is an organization that offers technical assistance and policy support to create housing with lasting affordability that builds equitable neighborhoods. They work for things like community land trusts, inclusionary housing, shared equity, home ownership, all of those really great things that I know a number of you are involved in thinking about as well. Tony is the CEO of the Grounded Solutions Network. Prior to that, he was the Senior VP of Master Site Development for the Urban Land Conservancy. So he's one of the few people doing this work in a DC-based way who's actually been out in the field doing the real thing. Prior to this, before he was at the Urban Land Conservancy, he was the founding executive director of the Atlanta Land Trust Collaborative. So we're just really delighted to have somebody with his extensive and very practical background join us today. And hopefully, in addition to listening to his remarks today, you'll all reach out and learn more about what the Grounded Solutions Network has to offer you in your work going forward. So with that, take it away, Tony.
Thanks, Julia, for that gracious introduction. And yes, we consider you all key allies in our work to really promote greater access to long-term affordable housing opportunities, particularly for communities of color across the nation. Certainly in this time, a number of us, I know Grounded Solutions is one among many that have been focusing even over the last several years on really advancing and centering racial equity in our affordable housing work. So I'm really thrilled to have this opportunity to talk with you all today about some of the things that we're doing at Grounded Solutions and give you a little bit of an overview on how our work is progressing and poised to expand over the next several years. Before I sort of get into a lot of detail about that, for those who are unfamiliar with Grounded Solutions, certainly you outlined our mission really around equitable, inclusive communities and the linkage of what we call lasting affordability. That really still remains the core of the work, but the pursuit of it really focuses on what we call a five-pronged approach. First, collective learning, really bringing together the leaders who run housing programs that are focused on lasting affordability. And in addition to community land trusts, that includes limited equity cooperatives, Habitat for Humanity affiliates, and even municipal programs and inclusionary housing programs that often have deed restricted affordability covenants that have the same effect as a long-term or even permanent affordability restriction. So we try to promote peer learning across those groups so that they can learn from one another as well as us about what really works on the ground. And as you mentioned, I've been a community land trust practitioner for nearly a decade now. And again, even before that, my deep involvement in community development as Director of Real Estate Development for the Atlanta Housing Authority really has exposed me a lot to what practical challenges, obstacles, and some of the innovative solutions, how those play out for communities on the ground locally. And so, again, it's really important to me to continue to promote that concept of peer-to-peer learning. So I really value organizations like yours that are playing a key role in connecting organizations who, on the face of it, appear somewhat diverse and not really having overlapping work, but when you really sort of start to delve into it, they really do have a lot more in common than you would think at first glance. We also, as part of that five-pronged approach, do a great deal of research that really is the basis for building what we call the field around inclusive housing, shared equity housing in particular, which again, community land trusts are one model of shared equity housing. The idea of retaining subsidy in, say, an affordable homeownership opportunity rather than forgiving or recapturing that subsidy at some point in time, but retaining it permanently in the property so that it benefits more than one family. The initial sale is fine, but when it comes time to resell that property, balancing wealth creation with the idea that that same property should continue to be an affordable housing home and serve multiple families over time with one single initial investment, often involving public subsidy. So we don't have this problem of what some of our leaders term as the leaky bucket, where you subsidize affordable housing, and then when the affordability restriction wears off or expires, it either converts to market, and while that's great from a wealth building standpoint in the homeownership aspect, it does pose the challenge of how do you then create another affordable homeownership opportunity to replace the one that has expired. That's often at a higher cost over time. So making sure that we maximize the benefit of public investment is part of that. One example of that research that I just want to talk about briefly is in 2019, we partnered with the Lincoln Institute of Land Policy to release a study of shared equity housing performance that spanned a 33-year period and had a sample of just over 4,000 units. And there were some fascinating and really, in our case, milestone takeaways from that study. One thing is that there's always been this criticism that shared equity homeownership does not generate wealth at the same level as traditional subsidized homeownership because of that sort of idea that the homeowner sells and takes all of the equity and thus, again, is able to accumulate wealth as opposed to only allowing them to take a portion of the accumulated equity with them and then retaining the rest to keep the property affordable over time. But what that study showed, contrary to people's initial gut instinct, really what we saw was the average initial investment in purchasing any of those 4,000 shared equity homes. The average initial investment was about $1,800, and the average tenure of that buyer was 5 to 7 years, during which some part of that period they made the decision to, the majority of them made the decision to sell that home, and the average return of that limited equity that they were allowed to take out was just over $14,000. So $1,800 in, $14,000 out within 5 to 7 years. There is no other investment vehicle that we're aware of, be it stock market, playing the odds in Vegas, those kinds of things, high risk things, that will yield you that kind of return. And that was over a variety of market cycles, even sort of during the downturn of the Great Recession. And again, another takeaway of that research is that during that recession period, shared equity homes were 10 times less likely to be in foreclosure than traditional market rate homes. And again, that is because there is a nonprofit community land trust or some other type of program backstopping the homeowners and engaged with them in a process that we call stewardship to make sure that they're able to maintain homeownership, or there's some intervention before it gets to a point of foreclosure. So just a little bit about the research. We also have tools and resources that are focused on our work, and some of that spans policy. So in the case of inclusionary zoning, we have what we call an inclusionary zoning calculator as a tool that allows a jurisdiction that might be considering an inclusionary zoning program to model some potential scenarios from a financial feasibility analysis standpoint and determine what might be necessary in terms of some kind of incentive or some sort of trade-off with developer to make deals feasible for inclusionary zoning. So again, just another aspect of our tools and resources, and we have most of those available on our website, groundedsolutions.org, for folks to access for free as needed to support their programs and ideas. I touched a little bit on inclusionary policy. That's example of our work around policy change. Again, another aspect of the five that I want to talk a little bit about. We have both state and local policy work happening. Say in the Twin Cities, we were successful in partnering with them to pass mandatory inclusionary zoning recently at the end of last year. So we consider that a big win in terms of our local policy work. But again, we work nationally all across the US. So places like New Orleans, San Antonio, Winston-Salem, North Carolina, it varies dramatically in terms of the local context. We also have national policy work happening, and a lot of that currently focuses with the GSEs, Freddie and Fannie, in their Duty to Serve initiative. They consider shared equity to be one of the underserved markets that Duty to Serve is designed to target. And so we've been working with them over the last several years to make mortgage financing, more of that available and tailored directly to the shared equity housing sector. We actually worked with them to create a specific community land trust mortgage product now that standardizes that secondary market offering so that local lenders don't have to hold those loans in portfolio, which was a challenge at one point in time for folks who wanted to implement community land trust housing, finding a lender who would actually agree to provide the mortgages. So that's less of a challenge than it used to be. But also on the national policy level, looking at such things as the HUD Home program, a number of our member organizations, and we have a little over 200 of them who are formal members of our network nationwide. A number of them encountered challenges in the interpretations of the home program when we start talking about the difference between subsidy recapture and subsidy retention. So we're working with HUD to clarify and issue more guidance to local jurisdictions around how to make those interpretations, and again, how to support the expansion of shared equity housing more broadly nationally. We also have technical assistance that we provide both to nonprofit programs as well as local municipal programs across the country to improve the efficiency of their operations, and again, sometimes to actually expand the impact of their work. One example of that is we actually provided a business plan for the launch of what is now one of the most ambitious community land trust efforts in the country in Houston, Texas. The mayor of Houston made it a priority to utilize their disaster recovery funds from the 2 hurricanes that they had to, again, expand the offering of shared equity housing through a community land trust, a brand new startup community land trust that has been successfully launched and is rapidly selling homes even today there in Houston. And they do that in partnership with their local municipal land bank. The land bank sources properties. The city actually contracts for and has homes built on those properties, and then they are actually transferred to the nonprofit community land trust that markets and then stewards those homes in perpetuity as shared equity homes. So that's just a little overview of our work. And again, the areas of expertise, if you couldn't guess from that description, such things as community land trusts, inclusionary housing policy, including what we typically know as inclusionary zoning, but not limited to that. Could be a housing trust fund or some other type of affordable housing vehicle. And then other models of what we call lasting affordability, including rental programs that have some requirement to preserve and extend the affordability period of multifamily rental units. The Urban Land Conservancy that you mentioned, where I worked in Denver for several years successfully, has been building out large-scale multifamily rental using social impact financing fund called the Denver Transit Oriented Development Fund, tied to the expansion and build out of a public rail system there in Denver called Fast Tracks over the last several years. So it's rapid growth has been tied to the idea that housing and public transit should be linked in order to reduce the overall cost for low and moderate income families. One thing I do want to touch on, as I mentioned, our work has more and more been focused on centering racial equity. And one of the things I've lately begun to talk more and more about is this idea of the definition of community. We have this term community land trusts, and when people talk about the word community, often I find that we need to be much more precise and clear about what we mean when we use that term. I find it ranges from 2 extremes. One is, and neither is right or wrong, it's just sort of where you land. One is, just assuming that community means a group of people, and you're defining community based on their shared proximity in a physical geography, like a neighborhood or a city. And then the other tends to be more about a group of individuals who really acknowledge and value their social cohesion with some implied level of trust due to shared racial or cultural identity. So again, some definition around what we really mean. And in our work, we definitely have now intentionally focused on racial equity in terms of defining community, really understanding that the identity of folks based on race and culture really matters most to us, and we really want to serve increasingly numbers of communities of color. So really trying to target where we work, who we work with. We want to support organizations that are actually led by people of color, and also serving populations of color. And even the Community Land Trust model, one of the really unique characteristics about that in terms of it, the history of it, the origin is from the civil rights movement in the late 1960s in rural Georgia. And so really to overcome the kind of systemic segregation, discrimination, even outright violent oppression, it was necessary for folks to band together and gain ownership of land in order to protect their housing and their livelihood from farming. And so out of that, this community land trust model was born from leaders of the civil rights movement as a strategy to gain more control and empowerment. And so today, what that has translated into is the nonprofit community land trust governance really is what we call tripartite. At least a third of the board of directors of a land trust is meant to be residents of the community that it serves. And then another third can be residents in the general surrounding area, and then yet another third can be folks with specific expertise that might be needed to support the program, like legal backgrounds or finance backgrounds. So really trying to balance the interests that are necessary to have a successful organization, but also give meaningful decision-making authority to the people that the organization actually serves. So we try to carry forward with those values in all aspects of the work that we're undertaking at Grounded Solutions. And so, I talked a little bit about that Lincoln Land data and study, but what that's also led us to is right now we have a number of what we call signature initiatives operating across the country. One that I'll talk about is a land bank land trust partnership. It's a cohort of 3 cities, and that is Atlanta, Houston, and Portland. We have operating land trusts and land banks in each of those 3 locations. But as I described earlier about the operation in Houston, really looking to leverage that approach and increase the production of housing and preservation of housing with lasting affordability in those 3 jurisdictions. That's operating now. They are producing homes, as I mentioned in Houston's case earlier, but really looking at that as a means to grow the scale of an impact of our work nationally. We've recently internally adopted a goal of creating 1 million units, new units with lasting affordability over the next decade. And the path to scale that describes really means that we will be relying on signature initiatives like this land bank, land trust partnership, but also things like we have another cohort initiative that's focused on inclusive housing policy called For Everyone Home. And we're working with 3 cities, San Antonio, Winston-Salem, and Indianapolis, Indiana right now on those inclusive housing policy strategies. It'll look a little bit different in each city, but again, the ultimate goal is to ramp up the production of housing with lasting affordability. And so using those as examples and really pilots, we feel like we have a viable path to scale if we can achieve additional philanthropic and social impact resources over that next 10-year period. That also includes an aspiration to have a national dedicated source for what we call shared equity housing expansion. We've put together a, concept for that as well. So if any of you have interest in talking with us more about that and learning more about it, and frankly advocating with us to have that included as part of the affordable homeownership strategies that all of us want to see be successfully implemented in a new administration. That's something that I would think we would welcome some additional conversation with all of you around. I'm going to pause right there because I've said a lot, and I know some of you may have questions about some of what I've said, but I welcome those, and looking forward to having much more interaction with this group and all of you individually as the months go forward.
Thank you so much, Tony, for all of that great information. Just a quick reminder to folks, you can hear more at groundedsolutions.org. Please do visit that. We'll put that up on our resources page as well. In terms of questions, we do have a question right away. Just as a reminder to folks, you can either use the Q&A, the chat, or the raise hand feature, and I'm happy to unmute your line as well. But Tony, the first question is around a cooperative approach with NCST Community Buyers and Grounded Solutions on approaching FHFA to create set-aside properties for community land trusts. Just wondering your thoughts on that.
I think that would be something that, yes, we'd be very much interested in exploring. Again, any method that we can determine to actually earmark some amount of properties for shared equity housing, we're all in favor of. In fact, I would say we've been starting to have some interest around really looking at what is the outcome of forbearance right now. We know the number of loans that are in forbearance. I don't think we know how many of those are going to be successfully modified or negotiated and come out of that other end. But then there's going to be some situations where folks are not going to be able to modify those loans, and the GSEs are likely going to have to create some kind of resolution around those. So I would be interested in having more conversation about, so those that cannot be modified or resolved by some other means, what is the future of those properties? And let's not just leave it up to the market to determine what that is. We know the lesson learned from the last recession was that did not turn out to be beneficial either for the communities nor for the housing sector at large, as properties continued to remain vacant and in some cases owned by absentee owners who really did not maintain them in a suitable fashion. So we want to avoid that in this situation. So some conversation and some development of strategy and tactics now, I think, is necessary to come out of this with some kind of focused approach to it, rather than just sort of on an ad hoc basis be trying to deal with it on a case-by-case situation.
And I just want to take panelists' prerogative to jump in there and say you are absolutely right to underscore everything you've said. It's my view, actually, that the place where we will see the most situations where people are not going to be able to successfully stay in their home is going to be FHA rather than the GSEs. And, you know, I think, you know, the forbearance take up at FHA now is upwards of 12% of their book, as opposed to the GSEs, which is, you know, only about half that, although obviously the GSEs have more loans. And we would love to formally partner with you around this particular issue. It's of the utmost importance to everybody on this call.
Let's do that, Julia.
Making progress already. That's fantastic. Tony, so are you seeing the growth of community land trusts in certain markets versus others, or maybe by region, east, west, northeast, or midwest? It seems that might be connected to higher cost housing markets, but you know, one of our colleagues would like your thoughts on that.
Yeah, I would not say it's specific to particular markets. There's a pretty good range where we see expansion happening. It is not just some of the higher cost markets, it's also in what we call emerging markets, those that are at the very beginning of what I would call gentrification because of some kind of either public infrastructure investment or some kind of economic development activity that is driving housing market transformation. So I can tell you that million unit goal over the next 10 years, the way we are thinking about that is that we will eventually, as time goes on, identify 60 regions, and that is not meant to be cities, counties, neighborhoods. It is really meant to be a regional approach and trying to focus on preservation and production from a regional standpoint, both in program and policy. It's been a challenge for a number of years, and even I as a practitioner faced it. We've been assuming that the replication of programs was a way to get to scale, but what we found was we're creating numbers of programs that were competing for the same resources. So we need to figure out how to leverage the efficiency of one program to, say, do stewardship on a regional basis and not have everyone trying to replicate the same activities using the limited resources. So we sort of toyed around with this concept for several years, and I was working on that during my time in Atlanta, called the central server, where we had some kind of centralized entity that could perform some of the really technical real estate related functions of shared equity housing. But then as we talked about, or I talked about earlier, this idea about community driven decision making could be happening on a smaller local level, but then have some coordination between this central server entity and what's happening at the local community decision making table. One of the efforts, more modern iterations of that, is called the Elevation Community Land Trust in Denver, Colorado, which operates on a regional basis. And that started out just as I departed Denver to run Grounded Solutions, with 7 local foundations investing about $24 million in an effort to grow the portfolio of this new homeownership focused community land trust, as opposed to what I was doing at the Urban Land Conservancy with multifamily. So again, having those two shared equity housing entities and some others working in the Denver region really has been jump-starting housing production there in a high-cost market in that case. The other example that I point to is the Fruit Belt Land Trust in Buffalo, New York. Not kind of at the other end of the spectrum, but a local hospital is doing a major research campus expansion there that is driving displacement for local residents. So they got together, formed a new community land trust, and actually got the city to do a moratorium on some city-owned properties, the disposition of those, and give the land trust priority once it had the capacity to take on some of those properties. So connecting back to this idea that there needs to be some dedicated portion of public property or public controlled property that can serve shared equity housing.
Thank you so much for that. I don't see other questions. Lots of praise, certainly, Tony, for all of your time this morning. And we truly appreciate that and the partnership as well. Just a reminder, folks, go ahead and visit groundedsolutions.org to learn more about all of the great work that this organization is doing. And Tony, thank you so much for your time.
Thank you all. And yeah, be in touch with us. We got some exciting things coming up, and love working with you all as well. So Julia, I hope we'll be in touch more frequently as the weeks go on.
That'd be great. And you are absolutely welcome to stay on the call now, because the next thing that's going to happen is I'm going to talk a little bit about policy. And there are a couple of important things that have happened that are of interest to, I think, everybody on the call. So I hope, you know, what usually happens is after our outside speaker leaves, everybody else drops off. Don't leave today because you want to hear some of my policy updates. I promise you that.
I'll do it for you, Julia.
So, you know, that obviously, Tony, go when you have to, but I'm just
Oh,
making
no.
my little promotional statement here.
Yeah.
So thank you again. Really delightful to have you on. It's actually just nice to see your face. We're all, you know, alone in our little rooms here. There are a few exciting things happening in Washington that I wanted to make sure everybody knew about, that NCST has been involved in. And the first, and I have to give a shout out to Al Pena, I'm not sure if he's on the call, but we made the choice to comment on the Federal Reserve's decision to create, well, or the congressional decision to create this Main Street lending program by the Federal Reserve. And the first iteration of the Main Street lending program excluded nonprofits and excluded organizations with less than 50 employees. And we thought about all of you, and we thought, well, that pretty much sucks for everybody we work with. And so we did submit a public comment urging them to include nonprofits and urging them to include organizations with fewer employees, and explaining to them how particularly businesses that work in development don't necessarily have that kind of payroll that certain other types of businesses have, but still provide quite a lot of employment to contractors and other folks out there. And so I'm really delighted. Apparently we were not the only people who wrote in about this. So I'm delighted to say that the Main Street lending program that's being launched now by the Fed, and these loans will be originated through third-party banks, kind of like the PPPs. It includes nonprofits, and the limit is now 10 employees. So that should include a lot more folks. You know, it is a program that's intended, you know, not for the very small business. The loans have a minimum of $250,000, but definitely something everybody should be looking into now that they've put out the final parameters of the Main Street lending program. So another really exciting thing going on, and you heard about this last week or 2 weeks ago from Chris Siglin, is we are really getting traction with the Neighborhood Homes Investment Act, which I think everybody here can recite in their sleep now, is a new tax credit program that will fill that value gap in single family development in neighborhoods where there are more lower value homes. Frankly, the neighborhoods that most of you are working in anyway. And now not only has that legislation been introduced in a bipartisan way in both the Senate and the House, but it is included in the House draft of an infrastructure bill called the Moving Forward Act. And we are hearing now, there's talk of potentially having it be included in the emergency legislation that we are expected to see in the next several weeks. So this is huge, and obviously, you know, a game changer. And I'm just really excited to be able to share that news with you. And of course, if anybody has any questions about either of these programs, get in touch with Chris Siglin or myself, or anybody else that you are normally in touch with at NCST. A couple of other policy things I wanted to touch on briefly. First, there is a fairly robust effort to get some forbearance and foreclosure prevention related provisions into this next piece of legislation. The most important aspects of that are covering all loans as opposed to just the federally backed mortgages. Ensuring that the post-forbearance options are ones that will keep as many people in their homes as possible. Collecting the data we need to know what's going on, particularly collecting that data with respect to geography and race and ethnicity. Because I think everybody knows that when it comes to servicer data, we're mostly in the dark all the time. You know, we have HMDA, which is always way not in real time, and we don't really have a database about loan performance, and we really need that information. Something else that is being talked about in Congress tracks what Tony said earlier in his remarks, which is to talk about the ways in which the disposition of any properties where people do end up losing their homes, whether that disposition is done in a community positive way, in an affordable way. And so NCST continues to be involved in these conversations. Again, this is where I emphasize, while it's often easy to think about Fannie Mae and Freddie Mac, as you know, both of those companies have participated in NCST's REO match. Fannie now runs their own program called Community First. Freddie Mac still participates with NCST. But where we're mostly concerned is FHA, and I do want to briefly explain why, which is FHA no longer has a functioning REO system. The FHA REO conveyance process has been broken for a long time, and as with many broken processes that don't get fixed, the result has been the mass movement to a workaround. And that workaround is these third-party sales. People call this the claim without conveyance of title program, which has had a series of rule changes over the past year with the goal, the goal of the servicing community and of the FHA team is to really see 90% or so of HUD foreclosures end up being sold through that third-party sales program, as opposed to being conveyed into HUD's REO portfolio. I think most of you know that HUD does have a homeowner first look. They do have programs where they sell to nonprofits. They do have the Good Neighbor Next Door program. None of those programs apply when a property is sold out through the third-party sales process. So NCST is looking into how to import those first look type elements into this third-party sales program, understanding that there is no energy right now to fix the REO conveyance system. So these are important things that are all being talked about in Congress right now. The last thing I want to mention is regulatory, which is that NCST, in conjunction with 25 or so other organizations, are still urging both FHFA and FHA to reduce the penalties that are assessed on loans that go into forbearance between the time of the closing and the time of either the securitization or the insurance coverage if you're on the FHA side. And so we're now going to be trying to follow up with requests for meetings at those agencies, because what those policies are doing is causing a lot of unnecessary overlays on the access to credit side. We're kind of in a sense, we're taking what is a problem that is really not that large when you think of it from a volume or dollar value perspective. And just because of the uncertainty and the way that lenders work, which is give them any excuse for an overlay and their lawyers will take it, we are seeing these things have a disproportionate impact on access to credit. Again, worse on the FHA side than on the Fannie and Freddie side. So I want to stop there to have time for questions for that or for anything else that anybody on the call wants to bring up.
Thank you, Julia. Lots of great feedback as you were giving your update. People are excited about these updates, which is fantastic. We've got JR. I'm going to unmute your line. Are you there?
Yep. Hello, everybody.
Hello.
Hello. First, I wanted to say thanks, Tony, again. I'm just calling in from Chicago. Appreciate all the policy work and things of that nature. Did we strike anything in the HEROES Act in terms of getting Fannie or Freddie or FHFA to signal that they are moving in a direction where forbearance is likely to happen? Just because we're taking a lot of courses around evictions and expiration of these moratoriums on eviction, is there anything in any upcoming legislation that might extend these eviction moratoriums?
So the HEROES Act does have a great deal of attention to eviction moratoria and to forbearance. There's an entire section that improves both forbearance and post-forbearance options and extends those protections to people with private mortgages as well as federally backed mortgages. It also makes clear that for any landlords who obtain a forbearance, whether they are multifamily or single family landlords, that they would then need to provide that eviction protection to their tenants. So that's also something that's really important. Now, we don't necessarily have to wait for Congress to move on this. Both FHFA and FHA so far have been quite responsive on many of these issues, and understanding that we're facing a cliff just in a couple of days on multifamily evictions, there is a large coalition effort to get those agencies to extend those protections. NCST is also trying to get single family landlords included in that, because again, we know that most single family landlords, whether they are local or not, are still, smaller investors who, will be in a difficult situation if they can't get a forbearance if their tenants aren't paying. And we would rather have them get that forbearance and then extend those protections to the tenants than have them not get a forbearance and have to figure out what to do, because many of these small investors can't just cover the rent on their own. They're not all Blackstone. So those things are very much front and center in the HEROES Act. Very hard to tell right now where they stand in the Senate.
Additional questions from folks? This would also be a great time if you've got some updates in your communities that you'd like to share with the group around how things are progressing, given what has been a several-month shutdown. We'd be interested in hearing those as well. Not seeing anything right now. Julia, would you like to close us out today?
Well, before we close, I mean, we do have a number of participants on the phone, and I would like to open the line, even if you don't have a question for one of our panelists. I think we would like to do a little bit of a temperature check of what you're seeing in your neighborhoods with respect to the pandemic and economic shutdown. And, you know, I know a number of you are located in places that are likely having something of a resurgence of the virus, since I believe that encompasses like 37 states. And I'm just wondering if anybody can give those of us who are stuck in our own living room here in DC a little bit of a flavor of what's happening on the ground. Don't be shy.
All right, Helen, I have unmuted your line. We may have, Helen, are you there?
Yes, I'm from Chicago and
Wonderful.
represented by Community Male Empowerment Project. And it's a non-for-profit, and we do look and work with the city and NCST with acquiring properties. And these properties are usually on the demolition list, which is the property is still workable, but we still have problems getting loans to, you know, improve the property so we can put it back out on the tax roll. And as it is right now, we're at a standstill. Can't get those loans because we're a small business. So with the COVID-19 and with not being able to access loan, we're at a standstill.
I think many people are in a similar position. Thank you so much for that.
Mm-hmm.
Stephanie Quick, are you with us?
Can you hear me?
Yes, I can. Good morning.
Hi, Stephanie Quick with Renew Indianapolis. Just a brief update on our end. So we are one of those states, of course, that are seeing a resurgence of COVID-19. So we're still pretty much working remotely. Our city and county agencies are working remotely. One thing I will say that we are definitely seeing as far as the homes, we are continuing to rehab homes, and we've listed a few here since May. Something that's definitely changed for us, which we had not seen before, was that we are definitely starting to see a slowdown in regards to not necessarily buyers coming to see our homes, but folks are definitely taking more time and being more particular in regards to making an offer, what they want out of a home, things that they'll require after the inspection is done. So as an example, we've had 2 homes on the market now for close to 90 days. And we had never, of course, never seen that before. And then also we just had one where the appraisal came back and it was about $10,000 below the list price, which we were not expecting that either. So that's just some of the things that we're seeing here that we're starting to experience. And I don't know if it's the same case for others or anything different.
Yeah, that's really great feedback, and something that we've been quite interested in is understanding how valuations might be affected by this crisis. So thank you so much for that. And if others have similar information based on their communities, that would be helpful as well. As we work with sellers on pricing and other things, it's really helpful to have on the ground data for that. JR?
Yeah, I just wanted to chime in and say we have seen a major increase in COVID-19 case, particularly in our younger folks' population. Our city is retightening its grip on businesses, restaurants, and things like that, which is causing some of a headache in Chicago, because you now have a lot of landlords who fear buying properties or new property, investment properties. And you also have a fear of other landlords who think that this eviction moratorium is causing them and I don't know how much people heard this in other markets, but there's a great misconception that the eviction moratorium means you don't have to pay rent. And so our fear is that a lot of renters are going to be going through evictions once they lift the shelter in place. And just if we can do anything nationally, we're asking folks to, put out a PSA or a message letting renters to know they do have to pay to have money to repay.
Thank you for that. Other feedback from folks or questions? This is all fantastic on the ground information. Julie, I'll turn it back to you.
Okay, well, we really appreciate hearing from you. I know sometimes folks don't want to talk on the call. Sometimes people get in touch with us afterwards. So we really want to hear these things. I have a suspicion that we are, sooner than some of the economists think, going to see a flattening of home values. And what we learned from the last crisis was that problems started not when home prices started declining, but when they started flattening. And so I feel very much on high alert around this. One particular problem, and please get this word out to your communities. There are many homeowners, and while I don't have hard data on this, if I look across data sets and make some educated guesses, I'm going to say a lot of these are homeowners of color or lower income homeowners who have gone delinquent and have not requested a forbearance because either they are concerned about rumors of lump sum repayment requirements, or because they are concerned about an impact on their credit score, or because they just, who trusts a mortgage servicer, right? I cannot emphasize strongly enough how important it is for them to contact their servicer and get this forbearance. If they're in a Fannie Freddie or a government loan, there will not be a negative impact on their credit score. There will not be a lump sum repayment at the end. FHA actually just rolled out a whole new suite of helpful modifications that people can use when their forbearance ends if they can't resume repayments at the previous level they were making them. I cannot begin to tell you how important this is. People who go delinquent now without getting a forbearance, they will be the first to go through foreclosure. And you just don't want to be. This is an unprecedented opportunity to hit the pause button, and everybody should be hitting that pause button. And we're having trouble getting that word out. So, I really want to encourage all of you to get that word out through the various ways in which you interact with homeowners in the community.
Wonderful. Thank you so much. Thank you to everyone for joining today. And as another quick reminder, please do mark your calendars for Wednesday, August 5th, where we'll be joined by Ann Myers and Robert Hickey with Habitat for Humanity International. Please also continue to visit our resources page for updates, and feel free to contact any one of us at NCST with updates about your particular locality or assistance that you might need. With that, we'll go ahead and sign off today, and thank you so much for your participation.
Thank you.